It was a sell-off on Wall Street today after we couldn't quite hold the gains, especially towards the end of the session. In fact, the Nasdaq was up pretty much all day up until the last half of an hour, and then the sell-off sent even it into the red. The small cap index, the Russell 2000, fared the worst. They were down 2% here today, and the S&P 500 was down about 1%. All sectors were in the red by the end of the day as well. Much of this was as a result of a report that came out that kind of threw some cold water on the Moderna vaccine trials that the market was so enthusiastic about yesterday. So kind of grappling with what news source we should trust and what that means for the economy. So we'll take a look at all of that. Then we'll get into our trade application example tonight from a stock that has been down and out for quite some time, but is finally showing some signs of life in an improving sector. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 19th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee. We also really encourage you to click like and retweet if you get value out of these nightly recaps. Lastly, we have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts here. And as I mentioned in the intro, we did have more than a 1% sell-off today in the market. So I like to kind of bring up this chart 6D whenever we have at least a 1% move in either direction. Today it was to the downside. Of course, yesterday was a huge green candle here that took us all the way up to this fuchsia-colored horizontal line for the first time since going back here to this candle on April 14th. So a very impressive candle yesterday. Today gave back just 1% of that 3% move that we had yesterday. So 2 steps forward, 1 step back. We'll take that, at least if you're long the stock market. That's generally an acceptable situation there. You can see that the VIX rose just a hair today. The VIX ended at about 30, which is still considered historically high. However, it is down significantly from where we were trading in mid-March as the market has seemed to get a little bit more comfortable with our path forward with the coronavirus and what it means for our economy. So anyway, another somewhat large day for the market, and we've been accustomed to that for really the last 2.5 months at this point. Let's go ahead and take a look now at our more traditional chart setup, and this will be chart 4B for those of you that are premium members following along at home. And you can see here that all 4 of our charts currently have a bullish posture. In fact, a strongly bullish intermediate posture according to the market forecast. So remember that the market forecast is considered bullish if its green line is either in the upper reversal zone or simply traveling higher between 20 and 80. So we have a couple of examples of each as of this moment in time. The S&P 500, you can see the green line is in the upper reversal zone above 80. You can also see that's the same case for the Nasdaq Composite down below. So both of those are considered strongly bullish, regardless of whether the green lines are rising or falling. Because they're in the upper reversal zone, we consider them strongly bullish. The other two, over here, you can see the Dow Jones, where the green line is not in the upper reversal zone. It's at 76, but notice it's rising. That's what's very handy with these labels right here. Can't really tell with a naked eye whether that green line is going up, down, or sideways. So the label will let us know whether it rose or fell from the prior day. So as of this exact moment in time, it is rising. Therefore, we do consider that a strongly bullish posture as well. Remember, when the line is rising between 50 and 80, we would consider that strongly bullish. If it were rising between 20 and 50, then we would just consider it weakly bullish. Same thing can be said down below with the Russell 2000. You can see in this case it's at 69 and rising. So if you were just to read all of those numbers, that gives us a reminder that it is the Russell 2000 small cap index that is struggling the most. As mentioned in the intro, the Russell 2000 was actually down 2% here today. I know when I do these videos a bit late in the evening that they kind of cross this out for some reason on the Thinkorswim platform when we look at the Russell 2000, and it shows 0% return, but it was actually a 2% down day for the Russell 2000. So, and again, a reminder, once life gets back to normal again, I'll start being able to get these videos out earlier as well. It's just that right now I've got to take care of my 5-year-old during the day until my wife gets home from work, and then she can take over and I can do these videos at night. So thank you for your patience along the way. Eventually, as life gets back to normal and daycare start opening and everything like that, I'll start doing these videos hopefully fairly soon, right after the market closes once again, just like I used to. Anyway, one other thing I should point out is that we do have what's known as bullish intermediate confirmation signals that have kind of been stacked up on all 4 of our charts here today as well. Remember, that exists when we have a bullish intermediate posture, which I just got done showing you is the case for all 4 of our charts. And that's combined with a red line in the lower reversal zone. And you can see that is the case with all 4 of our charts as well. There's the S&P 500 red line down below 20. There it is for the Dow Jones Industrial Average. There it is down below with the NASDAQ Composite. And then lastly, the Russell 2000. But like we've kind of talked about in the past, there are ways of kind of trying to evaluate whether the signals are more ideal or less ideal. And in this particular instance, we find less ideal examples of the bullish intermediate confirmation signal. One of the main reasons behind that is that the blue near-term line is not hanging out between 20 and 50. You can see in the case of the S&P 500, it's at 81. Dow Jones is at 78, NASDAQ it's at 83, and then Russell 2000 is at 84. So the whole point behind that is trying to get a sense of whether we've actually had a big enough exhale. Remember that the bullish intermediate confirmation signal is actually a buy the dip signal. It's looking for a security, or in this case an ETF or an index in an uptrend, and then waiting for some sort of a pullback to buy that at a cheaper price than somebody who would be buying on breakouts as that trend continues up. And so it's a buy the dip signal, and if the blue line is too high, the problem with that is it doesn't really feel like we're buying much of a dip, right? In this case, you can see like with the NASDAQ Composite as an example, yeah, you got a bullish intermediate confirmation signal here, but let's be honest, it only fell 0.5% here today. We're still very close to multi-month highs. So it doesn't really feel like you're buying much of a dip there. Maybe a little one, but not a big dip. And so we kind of like to see those blue lines down below 50, but still above 20. And that gives us a sense that there's been a little bit more of an exhale, a little bit more of a dip to actually buy. You can also see in some of the cases we have some pretty extreme readings on the red momentum line down below 5. And those sometimes are not always the best setups either. Let's go ahead and take a look at our next chart setup now. And this one will be our 3 green arrows chart setup. This is chart 4D for those of you following along at home. As it stands right now, I do have something new to report, and that is that the Dow Jones Industrial Average does have a 3 green arrows signal, which is somewhat surprising considering we haven't really been talking a lot about the Dow Jones here recently. But there was an interesting transition yesterday. Some of you might have caught it if you follow me on Twitter, that yesterday we saw a rare day of extreme outperformance of value stocks over growth stocks. It kind of reverted back to the normal course today, but nonetheless, perhaps that gave a little bit of an injection there for the Dow Jones Industrial Average, which has a lot of those banks and oil companies that would traditionally be known as value stocks in it. So as you can see, we did have the green line on the green arrow, I should say, on the MACD histogram show up here today to complete that 3 green arrows setup there. So that's why you see that background color being green in this particular case on chart 4D. With the rest of the charts, we still have white background colors, which tells us that we have a mix of green and red arrows, and therefore we don't really have a clear path in terms of a true trend at this exact moment in time. We're kind of waiting and seeing whether we can continue that upward trajectory that we've had since March, or whether this economy is ever going to catch up to this stock market, or the other way around, I guess would be a better way to phrase that. The stock market has been incredibly resilient in the face of what is expected to be a recession that we're all in right now from an economic perspective. But of course, the stimulus measures apparently have been working, at least in the stock market's eyes, and there's more buzz going around Capitol Hill right now that there may be a second round of stimulus checks on the way. So be on the lookout for that possibility as well, as we're kind of getting most of the states reopened to a degree around the United States. But there are still a lot of other countries that are struggling. In fact, I heard this morning that Russia now has the second most cases after the United States. And I know Brazil is really struggling right now as well with the coronavirus. So we're a long ways away from putting this global pandemic behind us. What it means for the economy is anybody's guess. But for the stock market's purpose right now, at least in the United States, it's been handling it in stride as best as you can imagine that it could. All right, let's go ahead and now take a look here at our 12 grid charts, starting with 5A, and this will be our asset classes 12 grid. And as you can see, we've got a healthy mix of both green and pink charts. The green charts, of course, are going to be bullish intermediate postures. The pink charts are going to be bearish intermediate postures. So as we look at this chart, one of the areas that I've been focusing on here has been gold. You can see down below, gold was up nicely here today, up almost 1%. In fact, for those of you that attend my factor-based swing trading class, the trade that we put on last week on our senior gold mining stock actually filled at our price target here today at max gain. So we were in and out of that swing trade in less than a week. That's exactly the way that we like them, if we can get them. Of course, we're not always going to be able to do that, but happy to report that in this case. So the gold mining stock did its job over the last week there for that class. And if you're interested in that factor-based swing trading class, remember, I'll be teaching that again tomorrow morning at 10 a.m. Eastern time. So if you're a premium or plus member of Market Scholars, feel free to join me there. But gold has been a theme that I've been talking about here in these nightly YouTube presentations as well, and it continues to look pretty good. It's not the strongest chart on planet Earth, but it is consolidating above a rising moving average and continues to have a strongly bullish intermediate posture according to the market forecast. You can see that the intermediate line is at 89 and rising, and remember, it can only go to 100, so you're up there pretty high in terms of strength according to the market forecast on gold bullion itself, and of course that translates over to the gold mining companies in many cases. In terms of other charts on the board, crude oil was up a little bit here today. Now we're using USO here, which maybe not is the best proxy. You could always pull up /CL. These are the actual futures contracts that do need to continually roll from month to month to month. But you can see that we've had a very nice rebound in oil prices over the last month and a half or so. It wasn't too long ago we were talking about negative oil prices, and all of a sudden today we do see crude oil futures contracts that are at their highest level since going back here to about mid-March. So there's been a decent little recovery that's taken place there in crude oil. You can see that the stock charts that are listed in the top 3 slots on the board in the upper left are all green, and that's a positive sign. Remember last week when I was doing these presentations, I think it was the middle one right here, the EFA, that was struggling on a relative basis where it had a weekly bearish posture. You can see it has now flipped back to bullish to join the U.S. stocks and the emerging foreign stocks in that case. So all 3 of those now have strongly bullish postures and are trading above rising 30-day moving averages. You can see that the long-term U.S. Treasuries chart is starting to weaken a little bit. This has been an interesting chart where, like has been the case in past moments of crisis, like in 08-09, you saw long-term treasuries spike higher as they were sought out as kind of a safety trade of sorts. But as the stock market has continued to rebound and market participants have been willing to take on additional risk, they've been kind of trying to get out of those safer U.S. government bonds and into something a little bit more speculative like stocks. And so you can see the wear and tear on the chart of TLT here. You're really in a little bit of a downtrend here in the last few weeks. Now, obviously, we're still kind of in the upper half of this chart. So over the last 12 months, or I'm sorry, the last 3 months, we're up 12%. So that's obviously a really strong performance for TLT. But most of that 12% gain was made in just that first month of March there. For the last, call it month and a half or so, we've either been going sideways or down. And where we find ourselves right now is below a falling moving average with a strongly bearish intermediate posture according to the market forecast. So TLT was up today. It was up 0.37%, but the chart is feeling a bit heavy. In fact, some of you might look at that and see a little bit of a head and shoulders pattern that developed over there. If you want to look at kind of the first week of April as the left shoulder, the head being here in mid-April, and then the right shoulder over here in mid-May. Now, of course, it's not an ideal textbook setup because you have this really weird price action that took place over here, but nonetheless, you are getting that sense that things are getting a bit heavy on the chart of long-term U.S. Treasuries, and therefore we might get a little bit of a boost in the interest rates here. You can see that interest rates, conversely, are now above their rising 30-day moving average. It's been a while since we've been able to say that. It did it briefly one day right there on the 12th of May, but otherwise for the last 3 months, what we're seeing right now is the first time this has happened for the most part in the last 3 months, where price is above that rising moving average. Notice the moving average line green, whereas this entire run in the last 3 months, it's largely been red during that time period. So strongly bullish posture on interest rates above a rising 30-day moving average. Let's go ahead and now take a look at our next chart setup. And in this case, we'll take a look at the U.S. sectors 12 grid. All right, so as this pops up here, you can see we've got a mix of green and red charts on this particular 12 grid as well. And it's the financials up here at the top rung that is dark pink, so strongly bearish. And then on the bottom rung, you have the consumer staples that are weakly bearish. And I went through a bunch of consumer staples charts, and they don't look all that good. Unfortunately for me, I'm a guy that tends to have more consumer staples as a dividend growth investor in my own portfolio. But I know going into that as a long-term investor, there's going to be plenty of times where that's a positive benefit to me, and sometimes it's a negative disadvantage to me. And right now, I am seeing a lot of those consumer staples that are starting to pull back. Even some of the hotter names like your Kimberly-Clarks and your Procter & Gamble's that were kind of the toilet paper companies that had a little bit of extra push to the upside as a result of the unique situation we all found ourselves in here a month or so ago, and they've been struggling a little bit. I should also add that this is the week where we have a lot of retailers reporting earnings. In fact, today Walmart, one of, if not the biggest consumer staples company out there, reported their earnings. And in the morning, it looked really positive. They were up a couple of percent, but by the end of the day, let me show you here, WMT is a ticker symbol, Walmart actually ended up selling off by 2%. A little bit odd. Look at this candle here on Walmart. It looked like it was going to be off to the races again, perhaps take out that old high, but the stock market had another thing in mind and really sold it off. So anyway, that one did not turn out so well. Another big box retailer, although it's not a consumer staple, it's a consumer discretionary company, was Home Depot. Home Depot also sold off here today. It was down about 3%. However, you can see that has been in a really, really nice upward ascent ever since bottoming there in March. I know I've done my fair share of consumer spend at Home Depot in the last couple of weekends as we've been getting a few things going with our garden and buying some trees and some different things like that. And each time I pop in there, it is busy as all get out, and you're waiting in line to check out for 15, 20 minutes, and that's both Home Depot and Lowe's. So those areas seem to still be attracting plenty of consumer demand. So we'll see where this takes us. It was one down day for Home Depot, but in general, it's been a very solid recovery since mid-March for those home improvement stores that we see out there. Anyway, as we look at the rest of the sectors here, you can see that utilities and real estate kind of round out our bearish sectors in the lower right-hand corner, and they have the dark pink background color, telling us that we have strongly bearish posture there. In fact, for those of you that were in my top-down trend trading class yesterday, you would have heard me talk about the fact that real estate on the sector selector is actually dead last right now. And it's been a long time since that's happened. In fact, 3 months ago, real estate was in the top 3. Now all of a sudden it's traveled from the 3rd slot all the way to the 11th slot on the sector selector ranking. So that is definitely a place that is out of favor right now, as the coronavirus has given a lot of people and companies excuses not to pay rent, and that is being reflected in the share prices of a lot of those REITs right now as well. So those are the areas that just aren't really holding up as well as the rest of the market. Now on to the more positive commentary, which is what are the areas that are holding up better? And those are your green charts on the board. And I would point out that communications is the #1 chart right now in terms of the market forecast intermediate line. Notice that the intermediate line on XLC here is currently at 88.93, and that's a little bit different because it had been technology that was leading, but you'll notice that now technology, its intermediate line is at 87 and rising, communications is at 88 and rising. So just barely, communications is actually taken over technology from the market forecast perspective. Both of those are in the top 3 on my sector selector, but according to the market forecast, you might have a little bit of a transition taking place up there at the top. And I want you to put a pin in that thought, because my trade application example tonight is going to come from that communications area. It's going to come from not one of the more exciting internet companies that has been supporting communications. Nonetheless, it is a communications sector selection here tonight that we're going to be talking about in just a little bit. Before we do, let's take a look at what else is working out there. Consumer discretionary has broken to a new multi-month high. Now this will take us back for a 2-month high is what we hit here today, back to where we were trading in the beginning of March. So about a 2-month high in that particular case. And a big reason behind that, many of you are aware that the most influential member of XLY is Amazon by a long shot. And Amazon actually hit an all-time high here today, if I'm not mistaken. AMZN, of course, is the ticker symbol. And if I right-click so we can all see this a little bit better, yeah, it did. On an intraday basis, you can see the top of this wick on this candle was higher than this candle over here when they reported their earnings. So while we didn't close at a new high on Amazon, on an intraday basis, we did hit a new all-time high here today. So obviously a lot of people still shopping online during these quarantine times that we find ourselves in right now, and that's helping to support XLY to a degree because of how important Amazon is to it. So that's another area. Seems to be holding up there just fine as well. Let's go ahead and take a look here at our ratio charts. This is going to be chart 5Q, and just wanted to see if there were any interesting reversals that might be catching our eye. One thing that does stand out to me is right here, equal weight versus market cap weight S&P 500. So this is the kind of orange colored candles in this chart on the lower rung here that I'm pointing at. You'll notice that this chart has largely been going down for the last 3 months. And that basically means that in this case of the ratio chart, the equal weight version of the S&P 500 is doing more poorly than the market cap weight. But that has changed in the last couple of days. You'll notice a big bounce off of the lows. Now, it hasn't changed the trend, but it has definitely kind of, reversed a little bit of that damage there. And you can even see that taking place a little bit here yesterday with growth versus value. In this case, we had a little bit of a dip in that chart telling us that value outperformed growth for that one day yesterday. But again, it's not breaking the trend, just something to be aware of because it was interesting and it was something that we hadn't seen in a while. So we see the equal weight version of the S&P 500 doing a little bit better than the market cap weighted version in the last week or so. And so that's telling us that some of those areas that have maybe been forgotten about, whether it's your financials or what have you. They're playing a little bit of catch up versus the big tech behemoths that have effectively become, the S&P 500, it seems, in the last year or so. Some of you have heard the stats that, the top 5 S&P 500 companies basically make up about 20% of the index right now, and those are the big technology-oriented and internet companies that are out there. So we've seen them take a little bit of a backseat here in the last week and let some of the other soldiers try to catch up to the generals. You will see here that we've seen a little bit of a reversal here in the small cap to mega cap variety as well. Small caps have kind of jumped a little bit here in the last let's call it 4 days or so versus, again, those mega caps. And then I also noticed up above here, commodities to bonds. Now remember, I just mentioned a moment ago that TLT was really struggling here in the last let's call it month or month and a half. That's your long-term U.S. government bonds. This is actually taking into consideration a more well-rounded version of bonds. This is ticker symbol BND. And so that is your kind of aggregate bond index. It's going to include corporates, munis, governments, all of the different types of bonds out there, not just government bonds. But anyway, you can see that commodities starting to make a little bit of a move there. So we already know that gold has been working. But as I mentioned, a little bit earlier in the presentation, even crude oil has started to work here recently. So while bonds have largely been tracking sideways, all of a sudden we see a little bit of movement there in the commodities. So let's keep our eye on that particular trend as well. All right, let's go ahead and get into our trade application example now. And for this, I'm going to pull up chart 3A. This is our swing trading chart. And I wanted to pull up a stock that has been kind of left for dead compared to so many other media names out there, and that is Viacom CBS. And this company actually had some positive press on it over the weekend in Barron's. And this is a company that's really, really fallen out of favor in the stock market in recent years. In fact, just in the last 3 months, you can see that 3 months ago it was a $36 stock that ultimately went down to $10 at the worst part of the crisis in March. Since that moment, it has rallied back and basically doubled from 10 to where we're at right now at around 19 or 20. So it's at an interesting juncture where it's doubled off of its bottom, but it would need to double again from here effectively to get back to where it was just 3 months ago. So in other words, while it's made a big move off the bottom, it could theoretically continue at some fairly aggressive rates to the upside. Then it depends on how do you want to play it and how much do you trust it, right? After all, anybody who's trusted this particular stock over the years has largely been burned for having that trust in the company. But you can see a little bit of a change in behavior of this particular chart. For the longest time, it had stayed below a falling moving average, and that would go back even beyond this 3-month chart I'm showing you here. But you will see that after bottoming here in late March, it started to shape this set of higher highs and higher lows. Now all of a sudden we find ourselves, going from a transition of thinking that this stock would use that downward trending moving average as resistance and continue into a downtrend into lower lows, to instead crossing up and through that moving average, now going high enough above that moving average to when it does pull back, it uses it as support here. So notice the difference. Here it was using it as resistance and riding it down. Once it was able to get above it, now it's using it as support and bouncing up and off of that rising moving average. So notice that the moving average color was largely red during this time period, transitioned to yellow here, and then basically since the end of April has largely been a green moving average in that case, with the exception of 1 day right there, which it easily bounced off of. So today was an important candle because not only did it bounce yesterday after the Barron's bounce, but it continued. It followed through here today. Remember, context is important here. The stock market was down over 1% today, and this stock was up 3%. Not only was it up, but it was an important up day because where it closed was a new high from the most recent trading. This is the highest level that it closed at since going all the way back here to about the first or second week of March. And same thing can be said for the intraday price. Now, the candle doesn't look great. it's more of a kind of a spinning top formation there, a little bit of indecision. But again, context is important. You shouldn't expect a stock to necessarily close at its highs on a day like today when the general stock market was down fairly significantly. So it did show relative strength clearly on a daily basis. And you can see that it now has not only this blue background color telling us that we have a swing trading bullish posture, but we also actually have a trend trading bullish posture. The green line that you see back behind here is trending higher, is almost in the upper reversal zone here as well. So this is a little bit of a catch-up play. Now again, there's different ways that you could think about playing this. Because of its reputation for burning people in the past, I'm going to try to play it a little bit safer here. What I'm going to do is I'm going to sell puts on it. Some of you that are going to be a little bit more aggressive, perhaps you'll think about buying calls if you think that this will continue. You'll obviously get rewarded much more handsomely than I would if that trade ends up working out. But in this particular case, I'm just going to play it a little bit more cautiously as a result of its underperformance over the recent years, but the acknowledgement that it's really starting to outperform here in the last week or so. So let's go ahead and place that trade. I've got it pulled up already. I'm going to sell 7 contracts of the June monthly contracts. They're the $15 strike price. And you can see right here that the bid right now is 20 cents. The ask is 34 cents. Our return on risk is over 1% easily in this case, 1.43%. So I'm just going to try to get filled at 20 cents tomorrow, which I should be able to get filled at fairly easily since it's sitting on the bid right now. Some of you that are trying to implement the similar type of a trade, maybe you try to go fishing somewhere in the middle between the bid and the ask. I'm not overly concerned about it. What I would say about this trade is as long as you don't think this is going to fall $5 per share in the next 31 days, it seems to be a fairly reasonable trade, right? We're basically committing to buying 700 shares at $15 per share in 31 days by selling this put. Now to look at the chart to see where the $15 level is, it's about right here where I'm pointing at with my mouse. And that by itself is a very important level on the chart as well. You'll notice that that is where it kind of topped out right over here in late March. It is also coincidentally the place where it bounced from right here on May 6th. So the old concept of old resistance becoming new support would also help protect our level there at $15. So let's go ahead and place that trade and we'll see if we can get filled first thing in the morning. Thanks for joining me here yet again tonight. David will be back with you tomorrow. Remember, if you're looking for additional content, my dividend growth investing class where we concentrated on the consumer discretionary sector has been posted to our calendar if you are a premium or a plus member. Also, David had his directional option strategies class here earlier today. Tomorrow, I've got my factor-based swing trading class in the morning, and then David will be teaching his options inventory class in the afternoon before going to battle for you guys here with this video tomorrow night. So if you got value out of the video, the way that you can thank us and show your appreciation and encourage us to do them every day is to go on over to Twitter and click like for us on our market outlook related posts, which you'll see pinned to the top of my timeline. Thank you so much, and I'll look forward to seeing you all on Thursday. Take care, everybody. Bye-bye.